Atul. Thank you so much for joining us.
That's great.
It's great to have somebody who's had 26 years of market experience, the benefit of working with Rakesh Jhunjhunwala, big name to work with, to talk to us. So, I wanted to check with you what's the sense you're getting on the markets right now, and is all the worry that's happening around the market just noise, or is it real? What is it?
So a line from George Soros comes to me. Bull markets are built on walls of worries. The day worries go away, that is when the problem is. So whenever the market is going up and there is a lot of chatter and noise and worries, like is it going to be the most beautiful idea? Is it 2008 again? And one thing I know that in my life, I don't think I'm going to see 2008. What you're prepared for never happens. Something else may happen. So all these walls of worries are very, very good, and that in fact tells me that the bull market will be longer and sustainable. Because when people are worried, they are controlled and they are careful. When worry goes out of the window, they go all in and leverage, and that's what happens. So for all major market tops, one thing I've noticed, and you also been in the market, that leverage, a very high level of leverage is important. And in this market at the moment, leave alone high level of leverage, there is very low level of commitment itself.
Yeah.
People are not all in, even on the liquid side, even on the cash side. People are sitting on high levels of cash. So I don't think that we could ever have a massive market top like 2008 recent. I mean, if you remember how crazy it was in 2008, I remember an IPO that was there, and there were lines in grounds where people were going and putting. There's no way. Markets are at new highs, and everyone has 10 reasons why it should not be here. And that is very, very good. So I think the market is not complacent. There are walls of worries, and which is very, very important because, as I said, bull markets actually always ride on walls of worries. When all the worries go away, everyone is so confident. They put all their money, they borrow and put money, and that's when you have problems. We're far away from that.
But hearing you, one tends to forget all the worries now, and it looks extremely bullish. So, how does one protect risks at this point in time?
See, I know for myself, in your case, it's a question of asset allocation, I presume, and all, and you can really actually dwell on this after I finish. But for me, I believe that I'm a long only fund manager. I don't have the luxury of shorting, etc. So for me, cash is a very important component. And I think that is one of the USPs of a PMS vis-a-vis a mutual fund. In mutual funds, you find that the thought process is that the client has given you mandate to invest in equity, so I must be almost fully invested. But in a PMS, I believe, or that's how I view things, it's about absolute returns. In case I feel the markets are going to have a massive correction, I have no qualms about being in high levels of cash. So absolute returns is my personal mantra, and in my risk management, stop loss exit or trend change is very, very integral. So if there is going to be a massive decline in the market, I feel that I would have moved into cash substantially. That's what my past or my experience in the past, that's what I've done in the past. That sort of sets me in. So risk management for me is triggering a stop loss, triggering an exit strategy, and sitting in cash. And markets have a way. Sooner or later, some other trends will. In 2008, everything seemed to have ended, and then what happened? Some new trends, new sectors, new stocks. You've got to be light mentally and financially to be able to participate in the next run. Market will keep on giving us opportunities. How would you manage that?
So, I think that basically managing risk is extremely important. And the question that the dilemma we always have is whether we should be performing versus benchmark or it should be absolute.
Right,
And
right,
hearing you, I'm almost tempted to think that that's a good way to go and say, let's look at absolute returns.
right, right,
Because otherwise, you keep getting compared.
right.
You say, here is a newspaper report, here is a website which is saying this is the best performing, this is second, third. Where are you? You're not there.
Absolutely,
So
absolutely.
that becomes a issue by itself. I think the important thing is actually handling the emotion of the client. So
Right,
it is basically saying that how much of sleep am I willing to let go
right,
for the goal or for that excess return that I want to make. And people have a choice. I mean, you can say I will, want my goal at whatever cost,
right.
or I want my sleep at whatever cost, or a balance of the
Sure,
two.
sure, sure.
So making sure that we understand from clients what is it that they are willing to lose
Right,
and their time horizon
right.
is an extremely important piece before we sort of recommend what to do. And it gets tough because, especially, this sort of thing works very well with clients who trust us, who have a relationship, and that, according to me, takes time. So, somebody new coming in and the market is
Yeah.
reacting at the same time, all my historical past performance of how well I handled other
Right,
clients
right, right.
is thrown out of the window because
Yeah.
then it's you and me, and you're saying, no, no, I don't believe you.
Absolutely, absolutely.
Yeah.
Another interesting thought just came to me, that clients, they may verbally express risk as a number, but emotionally, how much are they in sync? What I'm trying to tell you is that you do a risk assessment, and he'll say, "No, I'm okay to see a 10% drawdown, etc., etc. I want this kind of things." That may be at a very intellectual level, but when that number really happens, how much of the client is really prepared? So the intellectual and emotional, how do you manage this?
So,
Because there can be a lot of conflict, and there can be a mismatch.
yeah, so in fact, 2008, I recall, I was, dealing with a client who I knew from a long period of time. In 2007, he was at somewhere around 70% equity,
Right,
and he was saying, why not 90%?
right,
And we had to literally hold him back. Now, this client in 2008, after we had reduced his equity to 60,
hmm.
and of course it fell. So he says, Lovaii, you know me. How can you do this to me? And I'm saying, oh, this is a new you. Because I thought I knew you from long before,
Yeah,
but your behavior totally changed. So the risk profiling questionnaires that we use now, and I
right,
didn't believe, frankly, in risk
right,
profiling before this,
right,
but now that we use them and we have data now which compares people across in bands,
right,
gives me something to work with.
right.
And I think also the other thing I find is that, and I don't know what you find, but I find clients don't like static portfolios. They want something done. No, if you're not doing something, you're not
Need
paying
for activity.
attention to my portfolio. You're not even looking. Now it's fallen. See, you said buy and
Yeah,
hold. Then
yeah,
why do I need you? So I think that once I play in that band, it allows me to do that 2%, 3%, 5% of movement.
right.
With then clients feel that yes, you've done something.
You're watching it.
You're watching it. But more important than that, I mean, that's the fudging part of it. But if the client is within a band and our call is that you reduce risk at this time or
Right,
increase
right.
risk, it allows me to do that.
Sure,
Right?
sure, sure. I think
So,
that's very interesting. Like, when I was in broking, we used to have this funny situation, especially when markets are at blowout phases. So a client would never, so assuming he's bought a stock at 100, it's gone to 200, and you make him sell, right? And the stock goes to 210. That 10 rupees is going to give you so much grief, is unbelievable. But if that same stock from 200 came to 190, he never said anything. So it's very funny. A cash loss is okay, but an opportunity loss is your problem. So that is why very often I remember we could never tell our clients to sell, because if you made a client sell, and assuming who knows the top in a blowout bull market, that guy would like
yeah.
kill you for it. So that's why after a few corrections, you just stop telling sell calls and you said, boss, you write the journey. And somehow it's shocking, but how clients are just okay with that.
Yeah, so we have this situation where clients keep asking us, "Oh, you're charging a fee.
Right,
What's the value?"
right,
So if I was doing something on my own and I got X% return with your fee, I should get X plus
right,
little more. But my sort of submission is that that's not the only thing.
right,
There very often there is something that the client comes to us with saying, "Here's an investment call,"
right,
and our call is, "No, don't do this." We are not tracking thereafter how badly that did and how much we saved for him.
right,
And I
right,
wonder what sort of track record there is of and data somewhere if I can store and
right.
show him that, yeah, here's my value for the fee.
Yeah, absolutely. Even I sometimes wonder that the point you raised, that, hey, do I compare myself with the benchmark, or do I really compare myself with returns? Absolute returns to the client, what he's set out in his plan, etc. And I think find trying comparing yourself to the benchmark, trying to be number one is shooting yourself in the foot. It really, it's like trying to catch your own tail. I strongly feel, though I don't know how much we can communicate it to clients or make them believe in, but once you've set your priorities, your returns, risk, age, all those things, then I think you should be really benchmarked against that.
Yeah, so practically what we tell clients is that they will point out to a report which says this fund was the best
Yeah,
performing in the last
absolutely.
year, right?
The ranking one, two,
Ranking.
three. Yeah,
So
yeah.
I said, okay, great, you want to put into it because it's number one now, but it's
Right.
number one because of its past track record.
Absolutely.
Let's go back 1 year and see where that fund was.
Right.
And if that rank was not one, but it
Right.
was 25,
Right.
you wouldn't have chosen it in any place, any case,
Yeah.
right? So what's the guarantee that your choice now is going to work? But people don't get this. So
What's a good time frame for someone to, uh, sort of assess a fund manager or something like that? 1 year, 3 year, 5 year, 10. If someone invests in a scheme, right? The first year may not be something great. How much time should a client give a fund manager?
so funnily, when I started this business in 2001, with great reluctance, I said 3 years is long term,
Uh,
because it was very difficult. People
sure,
were
sure.
looking at 3 months as long
Yeah,
term
yeah,
in
yeah,
those
yeah.
days. And then I started meeting people from the US, and they said, "Oh, long term, yeah, 10 years."
10 years.
And I said, "Oh, okay, we are sort of underselling this long term
Yeah,
piece."
yeah.
And then you know the data of the index itself.
Right.
If I have done rolling 7 year periods, I've not lost money. So
Correct.
my guess is if I'm in equity, I should look at 7 to
Oh.
10 years. And that, like I keep telling people, there's no rewind button, after you get in and say, oh, 7 years later, I'm not the best or I didn't get the return. I can't rewind this.
Good. I wish you do more of that and get clients to have that kind of time frame.
But I think it's our job to go and communicate this, right? No one else going to come and help
Yeah.
us to tell the client that 7 years in equity is long term.
Yeah.
And interestingly, I figured from a fund guy that in debt, if you look at 3 year cycles, or maybe 3 to 4 years,
Right.
debt has done well irrespective of markets going. I mean, the interest rates going up or down.
Down. Yeah.
So that seems to be okay. 7 years equity, 3 year, 4 year debt. Maybe we should start talking about the 7+4
Yeah,
plan.
yeah.
7 batsmen, 4 bowlers, full team.
Yeah. Make a team of 11. Yeah,
Yeah.
I guess. That's a good one. No, that's really good. Good. So what, I believe you're doing some very interesting work on risk profiling, getting some softwares and things like that. So what exactly? Because I had a couple of wealth managers run through these risk profilers, and I had to give a number or some ranking. And honestly, I thought it was pretty garbage. But what different are you doing? What are the newer techniques or things? I found that historically what has happened in the past. I mean, I was not impressed. So what is the new stuff
So
you're doing? How is it going to be different?
frankly, I felt the same when I was looking at risk profile because my view was that if you are having a chat on a Sunday afternoon, you are relaxed, you will say your risk profile is X.
Right.
If I do it on a Monday morning when you face 2 hours of traffic and landed
Right.
up for the meeting, you are
Right.
feeling all het up, and your profile, in my mind, I thought was different. Then I was sort of reading and studying from the US markets more developed. And there we found that if you scientifically actually ask a bunch of questions,
Right.
it is possible to benchmark yourself versus somebody else. Now, the particular risk profiler we use is a company called Phenometrica, Australian based,
Right.
just acquired by a Canadian company.
Right.
And the interesting thing they do is they ask you 25 questions. Some of them tend to repeat at different points, so some different aspect of it. But what I love the most is that apart from giving a band and saying that you are a moderate investor or
Right.
a
Right.
conservative investor compared to 150,000 sub readings that they have, so there's a large database.
Sure.
It also tells you that for these 19 questions, you are exactly the way your risk profile is.
Hmm.
But these two questions, you want to take far lower risk.
Hmm.
These two questions, you want to take much more.
Right. It's a
And what
deviation.
it does is, apart from the, pointing out and saying this
Sure.
is an opportunity for the advisor to have a conversation saying, okay, what's the story behind your feeling jittery about this piece a lot
Right.
more than you
Right.
otherwise do. And
Right.
according to me, so our job is not just investing or investment management, is investor management.
Right. Right.
And if I understand the story,
Right.
then I, understand behavior far better, and hopefully I can
Yeah.
handle them for a longer period of time.
Yeah. It's about the feelings, feeling your feelings.
Yeah, it is.
really want to thank you for giving me the opportunity to one is come and meet your investors for sure. Some of them have invested in my fund, and more importantly, is to meet your team because I feel that ultimately it's their faith or their understanding of the process which is more important. Because ultimately they are the boots on the ground and they transmit it. So I think that also was something which um, I really want to thank them for coming. Thank you for giving me the opportunity, and hopefully we'll do many more of these.
Yeah, so from our point of view, I think that we couldn't have chosen a better person to speak while you had enough and more of technical knowledge. But the simplicity with which you communicated with, I think the clients really appreciated. And it gave us some more work and some new ideas to
Yeah, why
work
not?
on. So that's good. And hopefully, yeah, we'll have some more interactions
Thanks,
going
thanks a
forward.
lot.
Thank
Thank
you
you.
very much.